Well, welcome everyone, and you did save the best for last, right? Digital assets, to me at least, and probably to all these folks up here, happen to be the most interesting, I would say, where the most opportunity may be, area that is currently, that we're all currently looking at and paying a lot of attention to. I will end up having our panel introduce themselves because it's helpful for them to tell their story as it relates to digital assets. We are going to focus on a range of things. I think that pressing issues relate to digital assets in both ETFs and ETPs, tokenization, DeFi, what may be happening with regards to clarity and the Genius Act and the impact they may have. And so we have quite a bit to potentially cover, and then we also want to answer some questions. And so I'll start out by asking the group, starting with Alex, to introduce themselves and what they do.
Thanks, Morrison. Alex Exathalis. I run distribution at Strive. Strive is an institutional asset manager and a structured finance company. We're the 7th largest corporate holder of Bitcoin and employ a structured finance approach to Bitcoin accumulation.
Hi, I'm Blue Macellari. I'm head of digital assets at T. Rowe Price. I'm responsible for both crypto investing and also our tokenization efforts.
Hi everyone, Mike Delavalli here. I'm an audit partner at Cohen & Co. and I lead up our digital assets practice. At Cohen & Co, we work with investment advisors and ETF issuers across the entire investment industry, private funds, public funds. Specifically in ETFs, we're the 2nd largest auditor of ETFs in the United States, and we work with many of the crypto ETF issuers as well.
I'm Jerry O'Shea with Hashdex Asset Management. We're a crypto asset manager. We've been around since 2018. We've got just about 20 ETPs across 8 countries now, headquartered in Latin America, 2 ETFs now in the US.
Great, thank you very much. I think we want to start, I'll ask Blue and Jerry to talk about where we are, and I'll have Blue focus on ETFs and Jerry focus on ETPs, just where the state of things from regulatory and even market standpoint.
Yeah, so I think we've seen, since the first Bitcoin ETPs were approved about 2 years ago, we've seen an explosion in the asset class in both the number of sort of filers coming to market and the number of individual tokens represented in the market. We've also begun to see several products that are multi-token indexed and are hopeful that there will be multi-token active shortly. But one of the things we've seen is the market has begun to understand and move beyond Bitcoin. Several years ago, when you had a conversation about digital assets, it was all about Bitcoin, and what we've seen from allocators, investors, has been a beginning of understanding assets like Ethereum, like Solana, which we really view as disruptive technologies across the ecosystem.
Yeah, and I just add that to me, it feels like we're kind of, it's been 2.5 years now since the Bitcoin ETFs, and it does feel like we're moving kind of from the first generation of crypto ETFs to now the 2nd generation, and as Blue mentioned, that's things like index ETFs, other types of products, income ETFs, these types of things that I think we're going to continue to see a lot of product development going on. I mean, you can just kind of look at some of the headlines and some of the major institutions that have gotten into this space, in the last few months, even as recently as that, to kind of recognize that there is this broad recognition that this is an asset class that's not going away, and that there is going to continue to be all different types of demand for different types of products in this space.
And so I would love for you all, and I'll start with Blue, to speak about, so what's driving the interest? What are the investment themes, or what's the thesis as to the benefits? What are portfolio allocation models thinking about or doing at this point?
Yeah, so I think that there's sort of 2 elements to it. The first part is, what is that investment story, that investment narrative? I think people have looked at Bitcoin and often treat it as a macro asset, which is how we view it. And then we have additional tokens beyond that, which are investing essentially in the underlying blockchains, and those tend to be very disruptive technologies. I think almost everybody has heard, and we're going to discuss it over the course of the panel, but tokenization and stable coins. But these are turning out to really be the first sort of killer apps for crypto. And investing in those tokens represents an investment in truly disruptive technology. The other aspect that I think is really important is people are looking for diversification. And I think we've seen a number of different sort of large allocators or wealth platforms come out and recommend between a 1% and 5% allocation for diversification and what it can do to enhance the sort of traditional 60-40 portfolio. And I think something that's really important here is people love to talk about the volatility in our asset class. And I really want to say volatility is a feature, it's not a bug. And I think when we think about volatility, as our head of multi-asset research likes to say, if you find an asset that you like that has diversification properties that you want to add to a portfolio, if there's low volatility, you sort of have to back the truck up to the asset in order to get an allocation that moves the needle for you. And one of the features of crypto investing is that because it is inherently high in terms of volatility, you get a lot of bang for your buck in terms of a much smaller allocation, like a 1%, 3%, 5%. Can generate enough diversification and still be properly sort of risk managed within a portfolio.
I think I would add to, Blue mentioned kind of the killer app. Stablecoins are often described as being crypto's killer app, and I think that's a really important point because being involved in this industry for some time, most of its history is people kind of believing in this technology, going out and saying, crypto's going to solve this problem, it's going to fix this, it's going to do this, this, and this. That was all very theoretical. And I think what we've seen with stablecoins in the last few years is that there's been real utility. So finally people are able to say, okay, now I kind of get it. So the way that when we're out talking to advisors, when we're talking to institutional allocators, we kind of like bucket because crypto can be this big thing that confuses people, that angers people sometimes. And so the way that we kind of describe the current opportunity is, Morris was asking earlier, is kind of three buckets, right? So the Bitcoin as a macro asset or the digital gold thesis behind Bitcoin. You have the digital dollar thesis, stablecoins, which we really think is going to continue to grow, particularly in light of the legislation that was passed last year. And then the third bucket is something I think we're probably going to spend a decent amount of time talking about here momentarily is digital capital markets or tokenization. And so that's something that I think if you kind of look at where we've been, those first two, digital gold, Bitcoin, digital dollar, stablecoins, and now tokenization, that's kind of the direction that the industry is going, and that's where we see the most growth, I think, in the coming years, call it, the medium term, 2, 3, 4 years or so.
And obviously there's been a lot that's happened since 2024 when the Bitcoin funds were launched. What do you think the pace of change will be going forward? New product development? Are you encouraged by what's possible? What are the headwinds are you seeing, Jerry?
I take this, and sorry, because Blue, I'm going to ask Blue a question then too, and I promise we'll shut up after this because we've been talking a lot. But so I would say that the getting back to my earlier comments about kind of the second generation products, that multi-asset, the index ETFs is something that it's what we focus on at Hashdex. We partnered with NASDAQ about 6 years ago to create the NASDAQ Crypto Index. So our ETFs, the bulk of our AUM, are ETFs that track that index. And a year ago, or even 10, 12, 14 months ago, the conversations we were having with advisors about these types of strategies were typically, they were curious and maybe skeptical, but there was not really the sort of buy-in that this is an asset class that deserves its own index or its own kind of opportunity from that perspective. And those conversations have really changed. And so I think in terms of thinking about products, the multi-asset index ETFs is a big one. I know you mentioned that active as well, which I think is something that advisors are going to be looking at as well. So I don't know if you want to add anything, Blue, to that.
Yeah, I think we talk about crypto trades 24/7, 365, and that's not just a saying like our market moves all the time. Our market moves all the time. We have 168 trading hours a week. And so I think a lot of advisors, when it was just like, do I buy Bitcoin and the fund is 100% allocated to Bitcoin, that was one conversation. When you talk to advisors or allocators now and they say, well, there are ETFs on 15 different tokens, I don't understand what most of them do, the market trades 168 hours a week, it's not unusual to see annualized vol of an index to be 90%, 120%. That's a pretty daunting sort of portfolio to attempt to put together on your own. And that's a lot of very, very important due diligence. And I think that advisors have sort of moved beyond Bitcoin. They've moved beyond just a couple names. And now they're going to really need help trying to figure out how to sort of put together a portfolio. And the multi-token products that are coming online increasingly solve that sort of conundrum for them.
Alex, I will definitely ask you to chime in. You all are taking a sort of a different approach to some degree, and I would love to hear about it.
Absolutely. I think I agree with the L1, L2, L3 approach, right? Bitcoin or a token as L1. Layer 2 for us is the issuance of a perpetual preferred equity. So at Strive, we're Bitcoin maximalists. So we don't take the broad approach, we laser in. And we're looking to create a simple operating approach. So our common equity is a levered Bitcoin exposure. We accrete Bitcoin onto our balance sheet using the financing tool that is a perpetual preferred equity. Strategy does this. They have four symbols. We have one. The ticker is SATA. Morrison's my lawyer, so I'm not being, I'm in compliance here. This is a perpetual variable preferred instrument. It has become the preferred way to finance Bitcoin. We made an announcement today that we purchased 2,500 Bitcoin last week, financing through this vehicle. Strategy has been doing something similar. SATA pays 13, STRC pays 11.5. So we're re-rating the risk curve and the yield curve for fixed income, and we're doing it by buying the most pristine asset that exists, taking the volatility of that asset, right? If you think of Bitcoin, you call it a 40 IRR, 45 vol asset. That's not appropriate for most investors. We're happy to harvest both most of that return and that volatility on our balance sheet, and we're offering a perpetual preferred equity that clips a 13% distribution and gives you a 5 to 10 vol, something that's highly palatable to investors. So we're structuring two solutions, very simple, levered Bitcoin, an income structured product with a low vol profile. That's going to allow us to, do what we're doing, and that's to own and accumulate the best asset on the balance sheet. And lastly, on the asset management side, we're filed with the SEC, and we will be launching the first digital credit ETF, making a more palatable solution for most investors than buying a perp.
Wow, and it does speak to the potential, right? This is one means to exploit the asset, and more are obviously coming. I'm with Mike. Mike, you're a nuts and bolts guy. He's an accountant. Cohen's heavily involved in digital asset space. What are some of the challenges for let's start with ETFs and then also ETPs that are holding digital assets?
Yeah, definitely. Starting off with putting crypto into 40 Act products, for example, the biggest factor, or one of the biggest factors from a tax perspective, is ensuring that the 40 Act product maintains its RIC qualification or its RIC status. And as of right now, that's really done via futures, options. You can use a foreign corporation to harvest some of that income and have it be qualifying income, but you're limited to 25%. And then with another component of that is with the Clarity Act being in Congress right now, all eyes are on the tax side of things, and it's going to be interesting to see how that kind of evolves over the next few months or so, and what kind of changes could potentially be coming of those rules. And then for the crypto ETPs, there was a big development over the last year relative to staking. So staking was allowed in the 33 or in the ETPs, the 33 Act ETFs, and that's really important, especially for digital assets like Ethereum and Solana, where you have an ETF on Ethereum and Solana, and if you can't stake the asset, anyone who buys that is foregoing the yield that they could otherwise earn by holding the asset outright and staking it directly on the network. So that was a really big development that was very favorable for those products. And then towards the end of the year, the IRS released guidance on safe harbor for staking income, as far as allowing it to be to basically providing a framework for issuers to follow related to distributions of that staking income, which just kind of continued to give some more clarity to the market, and really provide that regulatory framework that they can use to to basically run these products.
Yeah, and this is a question for whoever wants to take it. We've been talking about ETFs and ETPs, and they are designed to do similar things, but they are different. Does anyone want to tackle sort of the major differences between the two and perhaps some of the structuring issues associated with those?
I'm happy to. I'm not a lawyer, so please don't take all this with a grain of salt. But as commodities for the Bitcoin ETFs and other crypto ETFs, they're regulated under the 33 Act, so they're ETPs technically. It does get confusing. For instance, our ETF it's called an ETF in the actual title. It's technically an ETP, but it's not the biggest difference is that it's not a 40 Act fund ETF, and that's kind of the line of demarcation there that is important in the space, and why sometimes you'll hear the terms be used interchangeably, and it certainly can get confusing for people sometimes, but that's essentially how I look at it.
Yeah, and just for perspective, the Investment Company Act provides protections that aren't provided in the 33 Act. It's a conduct act, so it provides a board, or requires a board, limits affiliated transactions. It requires that you go through a process for approving the advisor, but it also requires that the fund consists primarily of securities, right? And so the 40 Act ETFs end up using derivatives to get exposure to crypto. The 33 Act funds don't need to do that because they're not supposed to contain over a given amount of security, so they're structured in a different way. So we're working within a sandbox with limits, and I think part of what all these folks want to do is to expand those limits so there's perhaps equal treatment between securities and digital assets, so that perhaps you get the same tax benefits that you could with securities, or you could have the same ability to hold assets in a given structure. That's part of what's going on here. And as we talk about what's going on, I think it may be worthwhile to talk briefly about where we stand with clarity, which is a major piece of legislation. And for any of you that wanted to sort of talk about the potential of clarity and where we might be, that'd be great.
I can go first and kind of give my 2 cents. So the Clarity Act is digital asset market structure legislation. It's not surprisingly a huge priority for the industry to get this passed. Timing-wise, the president is supportive of it and has said he'd like it to be at his desk by the July 4th recess. So that's a very small window of legislative time for the U.S. Senate to consider it. So right now, where our estimates are, it's probably a greater than 50% chance that it passes, but it's certainly not a done deal. And I was looking at Polymarket. I think Polymarket might be under 50% right now. So it's unclear, exactly the direction that will go. It's a hugely important piece of legislation for the industry, particularly for assets outside of Bitcoin, because Bitcoin has really enjoyed kind of some regulatory clarity as being a commodity for some time, but those altcoins are still kind of that level of clarity. They're kind of clamoring for that to be in statute. And obviously there's things that can be done from executive orders or the SEC, CFTC, the regulatory agencies, but really getting something into statute will help kind of make this, the framework for this industry much more permanent. And that being said, I don't think, if it doesn't pass, I don't think that really changes any of the structural trends that we've seen in terms of institutional adoption, investor demand. You know, it certainly, I think, would probably slow the process of institutional adoption a bit, but it's certainly not a kind of all or nothing thing if the legislation doesn't pass, and it probably would need to pass in this next month, because after that break, we're getting kind of into the election season. I don't think anyone's expecting much to happen later in the year.
And Blue, can you speak to what you're working on at T. Rowe now, and will clarity have any impact on what your digital asset focus may be?
Yeah, I think we're a really good example of a large traditional institution, and one would imagine that we're the people who are most seeking sort of very clear regulatory guidance, which is often the case. I also agree that in the instance of the Clarity Act, I think it's a nice to have. I don't think it's as critical to the future of the industry as perhaps the crypto market and perhaps Twitter believe it to be. I think there are some really important things in there. Right now, the way the CFTC works is it regulates derivatives, right, of commodities. It doesn't actually have oversight on spot physical commodities because nobody's watching when you put gas in your car and saying that's a transaction. Up until digital assets, we didn't really need to think about that, but these are commodities and you could trade digital assets with your next door neighbor. And so one of the things that's really, I think, quite valuable in Clarity is it gives the CFTC sort of oversight of spot crypto exchanges, which right now are, regulated through a hodgepodge of very crazy state-by-state sort of mismatch of things. But they're basically regulated in the same way we regulate Western Union, which should concern us all. It's just totally not fit for purpose, right? And there's just a lot of guidance. There's just a lot more clarity on SEC, this is your lane. CFTC, this is your lane. And then there's also a lot of guidance for DeFi, which is decentralized finance, which you can think of as peer-to-peer code-based financial services, which may not sound that appealing to many people in the room, I get it, but there is a very, very big market for it, and there's a lot of regulation that's going to provide clarity, guidance, and some rules for that, and I think those are important. From our perspective at T. Rowe, in terms of both crypto investing and everything on the tokenization front, we have been getting sort of the guidance, the clarity, the information, the sort of sets of rules and interpretive guidance that we need from the CFTC and the SEC, who have been really active over the past 18 months. Would it be great to have a lot of stuff encoded sort of at the legislative level? Yes. But honestly, I think that the real benefit from Clarity is that it protects the guy on the street who's operating on a DeFi platform or on a crypto exchange, and it protects them from another FTX. And that's beneficial to the entire industry, but we don't actually need Clarity for anything that we're thinking about or currently planning in the next several years.
I think it's also, this is all true, right? The framework matters. State regulation versus a singular national regulatory framework is important. But, given that this is the summer where America turns 250, this is a strategic national imperative. Under the last administration, the industry was under attack, and therefore we were pushing innovation, brain trust, and a lot of capital and jobs offshore. And that has now since reversed. And, I think it really is a strategic imperative for our country to own this innovation. I mean, this is going to transform the world. And so, aside from the legalese, I think there's a real nationalistic approach to owning crypto and owning this innovation for the United States.
And Alex, I'll get back to DeFi with you, but I did want to talk to Mike in terms of, so what's important out there from an accounting, custody, regulatory standpoint that it's either part of clarity or not. What do you think is necessary? What's important in clarity from your perspective?
Yeah, definitely. So just to cap off the regarding clarity, I think one other thing to mention is just confidence of the market when folks are thinking about putting investment into tokenization or any types of technology like this. Like there really is, especially probably a little bit of PTSD from the prior administration about some of the things that were floated around as possible rules. And I think having something signed into law really provides that confidence that there is a framework in place. Thinking about an accounting standpoint, I'd say one of the areas that we see just a lot of, or we see a lot of challenges is specifically in valuation more than anything, and we see it in the ETFs and the ETPs, specifically around principal market. So these ETFs and ETPs are required to report their financial results under U.S. GAAP, and within that ASC 820, which basically says that you need to value the portfolio or the asset using the principal market. And normally someone might say, well, these are crypto assets, they trade 24/7, 365, like very easy to get a price, it's always trading. Not really, because principal market is defined as the market with the highest volume that can be accessed by the entity. And so with many markets spread across multiple jurisdictions, different liquidity profiles and individual market characteristics, that determination becomes pretty challenging. And so there's a lot of work that goes into determining what that is, and from ETF to ETF it could be different, right? Just based on what they're able to access or what their analysis is. I think the important thing in that regard is making sure that policies are written and they're applied consistently. When I think about less liquid assets that could be held, there are even more challenges surrounding discounts for lack of marketability and other things, and tokenized assets. Do you value them using a secondary an exchange price that they might be traded on if the underlying asset is a liquid, or do you value it like a level 3? And again, it comes back to principal market, which is just an inherent valuation challenge for these.
One thing I think is worth mentioning, and you had talked about custody issues as well. Just a description of what the blockchain does and is, right? And the rules were written for actual securities that were paper, and that evolved to something electronic. But when you're talking about a blockchain-related asset, all our rules are based upon this old system. It really doesn't accommodate this existing system. We have obligations for qualified custodians that don't work. And Mike, I'll have you speak to what you all have to do in terms of understanding that an asset actually exists and is properly custodied for purposes of a product that you might be looking at.
Yeah, definitely. So I mean, for a lot of the typical tokens that we see traded in the ETFs, they're held through what are considered to be qualified custodians under various state banking laws, and we would ultimately confirm directly with the counterparty, and it's usually a pretty simple exercise to actually get that confirmation. The problem is, as others alluded to, these are unregulated entities, and so we're required to do a little more to understand what kind of controls are in place and the reliability of that information. Ultimately, the assets are held on a blockchain somewhere. I mean, the third-party custodian, holding the Bitcoin, for example, such as like a Coinbase, is confirming that to us, but ultimately they're holding it on the blockchain in a wallet, so we need to be comfortable with that. And then in a case where a fund might want to hold another asset directly on the blockchain, or even a tokenized real-world asset, just gaining comfort on their private wallet ownership, which is a whole different topic, but that's definitely a challenge when it comes to the qualified custodian rules for exchange-traded products.
Sorry, can I jump in here? And I think that it's really important. It sounds super boring, and people are not excited about custody, and I get it. But one of the things that's really, really critical to understand about blockchain and about crypto assets and digital assets is these are bearer instruments housed on the internet. So it all comes back to the level of technological security at the wallet level. The single most important conversation you will have with anyone you are considering investing in digital assets is they need to be able to tell you front to back about how they custody their assets. And they need to know the technology of it. And if they can't discuss that with you, or you're not comfortable with the degree of sort of depth of expertise they have there, that should be a deep concern. And tokenization is different. When we tokenize assets, those are not bearer instruments, and so that's also an important distinction. But one of the results is, and this came up when we were doing our initial build at T. Rowe, and we were building an end-to-end sort of crypto system, and none of the providers for any of our services are names that anybody at T. Rowe was familiar with beforehand. And I was like, I know it's a little scary, but it's actually a good thing. You want people doing your custody who are best in their field. Like, these are people who win presidential medals for building the cybersecurity that protects, the Pentagon or the Iron Dome. There's probably 40 people in the whole world who can build code sufficient to safeguard your digital assets. And you want to make sure that your crypto is custodied by one of their companies.
I just add one thing too, because I think it's a really great point. I think it's one of the main reasons why the ETF and the ETP wrapper has been so popular, right? Because it's something you technically don't have to think about, right? That's being provided for you, and it's still, to this day, custody is a very scary thing, right? It's taking control of these assets and potentially losing them. That's something that even I think very sophisticated people in this space aren't comfortable doing, and so that's been, I think, and that will continue to be one of the strong points for accessing this asset class through a ETF or ETP wrapper, is that you don't have to think about that, and the custodians, are all being vetted, and I think as more traditional financial institutions start to get into the, right now the bulk of AUM within the ETFs is dominated. Coinbase is the dominant custodian, and there's a few others, but I think as the regulatory environment improves, we'll see more traditional financial institutions get in the space and kind of be able to spread the risk among custodians out more than it's been so far.
Alex, I talked about DeFi, where to pivot, just a description as to what that means, and potentially the pros and cons of a developing market.
Yeah, I mean, the next, that L3 that we talked about, the DeFi protocols, lending protocols like Aave, Camino. Blue and I are both Solana folk, but Ethereum also has some nice ones. This is a programmable layer where people can move off, take tokenized products, put them on chain, lend against, and that's something that's really palatable. This is TradFi speak, right? Everyone in this room understands that it's a lending protocol, and so it's in the news. It's probably gotten some undeserved negative headlines. I was listening to the founder of one of the big tokenization platforms, and he said, DeFi is good, the collateral has been bad of late. And I think that's an interesting anecdote and way to discuss. How do you think about it, Blue?
Yeah, so I think that DeFi is going to continue to grow over time. It is a way that there is absolutely a generational component to this, and there is a way in which Gen Z and Gen Alpha, I guess my kids are Gen Alpha, are going to engage with financial services, and a lot of that is going to be around DeFi. I think we've seen, for those of you following DeFi closely, you've seen a number of exploits in recent months. And a lot of that comes back to different points of vulnerability, but in particular, when you're bridging assets, and a lot of it has to do with custody concerns. But DeFi is an incredible tool that enables and sort of unlocks the version of like Uber or Airbnb, but for finance. And I think we shouldn't. It's easy to dismiss sometimes. And it's had, it doesn't get the best press, but I think it's, we'd be remiss if we underestimated its potential for growth over time. And I think Hyperliquid is a phenomenal example of what we've seen. Hyperliquid is a perpetual DEX, decentralized exchange, and it has seen a massive amount of growth over the past few months, and it was one of the sort of first places that people could trade perpetual futures on oil during the start of the Iran war, and a lot of sort of very traditional hedge funds investors began to turn to hyperliquid for off hours, 24/7 price discovery for commodities. And I think it's gained a lot of attention. And they've got like 12 people or something, because the entire thing is code-based. It's code-based self-executing. And I think that's sort of how things are going to continue to trend.
I think maybe we skipped over the tokenization component because in order to access DeFi, you have to tokenize your assets. So at Strive, we have a perpetual preferred equity that we're looking to tokenize, and I think we've disclosed that we look to tokenize by the end of the year. I would probably also want to tokenize my ETF and allow these protocols, and understanding, who then owns your instruments in DeFi, who's lending against it. And I guess the worst case scenario, we're investors, so downside scenarios play out first in our minds. What does this cascading waterfall look like if the same asset is getting lent out, rehypothecated? Once it gets out into the DeFi, there is a risk that you can't control that. You can initially throttle the LTV, the loan to value that you set in a protocol. I think regulation, knowing your clients, all of the things that are more TradFi are starting to come into this world. And I think that's the marriage, right? We look at DeFi, we look at tokenization. It's reconciling your source of truth, whether it's through the custodian, through the DTC, through a traditional TA and a digital TA. All of these first principles concepts have to align, and that's where we'll see the growth in this space, whether it be tokenization, DeFi. It's aligning TradFi first principles, knowledge and truth coming together on rails that are unequivocally faster, better, more liquid, and instantaneous.
And can we back up just a little bit just to describe tokenization? And there's tokenization where perhaps it's the same QSIP, it's effectively the same security in a different form, and then there's tokenization where it's something else. And anyone who wants to speak to that.
Yeah, so tokenization, very broadly, is just taking something that exists as a real-world asset, and that can be a fund, it can be a stock, it could be, a Monet painting, and representing the ownership rights on-chain by creating a token. And then it can move on blockchain rails. And the reason that people want to do this is because it is super cheap to move things on blockchain rails. You can also make those assets programmable. So if you can write an if-then statement for it, you can make an asset do that thing. So imagine you can have programmable collateral, you can have funds composed of assets that then behave in a certain way and execute. And what it means is that in financial services, people look around and realize that they can effectively, once there's critical mass, you can automate an entire swath of the middle and back office function. I, not very gracefully, will say that tokenization is going to do to the middle and back office what EasyPass did to toll booth workers. And it's going to be a 5 or 10 year process, and it's going to be running 2 systems before there's convergence. But we will get there because the cost savings is so radical. It's like 65 to 95% reduction in costs. So you can take those assets and represent them, and you can do it a couple different ways. You can do what is thought of as sort of digitally native. You have an issuer, and they can take their money market fund, and they can turn it into a tokenized asset and fund, and it will have the same sort of QSIP registration, and it moves on blockchain rails, and the blockchain serves as the transfer agent of record. You can also have indirect tokenization, which is sometimes called twinning, and you will get a platform, an individual could set up an SPV outside of the US. They can go in and they can buy ETFs. They can buy stocks, they can buy private credit funds, they can put them in the SPV, and then they can issue tokens that represent an economic interest in that fund. So if you are a fund issuer, you may already have a tokenized fund in the market and not know it because there are like 2,000 plus things that are tokenized in the market. It's worth a Google later. So there's some reputational risk out there. And so those are sort of the two. There's both native tokenization and then this indirect tokenization. And ETFs are the thing that everyone is super hot to start tokenizing.
Yeah, the one thing I might just add is I think it's important to keep in mind because there's, I think, somewhat of a misperception sometimes that like tokenization is changing the underlying asset in some way, and I think I like to kind of separate out that like the underlying asset, the economics of it aren't changing. It's the infrastructure that's changing, right? The Treasury is going to have its same maturity, interest rate, the stock, same thing, or the same type of return profile. So it's like it's almost. And I don't know that this is a perfect analogy, but I sometimes like to think of it as like the transition from, I grew up with CDs, compact discs, not certificates of deposits, and that transition from CDs to MP3s, right? It's like all of a sudden, it wasn't that the music was changing or the album changed, it was that now I could send this music to my friend that lived across the country for free, right? Or I could take one or two songs from the album and send it to someone else. And so I think like when you're thinking about tokenization, it's important to kind of separate out that it's not, at least in my opinion, it's not introducing new risks to the underlying security itself, right? That's all staying structurally the same. It's just that now you have this modernized infrastructure on top of it that's going to create more access, lower costs, and all these things that Blue was talking about.
Yeah, I was just going to say similar. I've heard the term an upgrade to the existing plumbing system, basically, right? So like tokenization as an infrastructure rather than a product or a new asset. I mean, we've now been tokenizing real-world assets for over 10 years with the stablecoin. And why do people like that? It was instantaneous. It worked. You could do a variety of things with it, and now you're starting to kind of see these other cases play out. And I mean, as you alluded to, like right now, like it actually is quite costly in many cases, especially with a fund, to tokenize it because you're basically doing it how you normally would. Plus, then on top of it, you're layering in the tokenization component, minting tokens or burning tokens based on what's happening on the books and records and the cash coming in and out. So certainly something, back to that earlier point with legislation, to have some confidence in how these, should operate and make them digitally native. Hopefully, like that's the end goal, right? To gain all the efficiencies.
Stablecoin's one example of legislation creating an opportunity. Can any of you speak to sort of the early impact of stablecoin and the potential?
So I can speak. So Hashdex, I mentioned, is based in Brazil, and one of the things that I think that's unique about crypto broadly is I do really think it's like the first truly global asset class. It's completely borderless, right? Like you can access commodities, but not everyone can access, a gold bar everywhere, right? With crypto, anyone with cell service, Wi-Fi connection can access this asset class. So what we've seen is like some of these use cases bubble up from places outside of, say, Silicon Valley, right? And so stablecoins is a great example of that, where I think a lot of people maybe weren't paying attention to how important a digital dollar would be to people outside of the US that don't have access to the dollar. And I don't necessarily think there's like a perfect parallel with what's going on to tokenization outside of the US, but I do think that dynamic is kind of creates a little bit of a different environment with this asset class than with a lot of other asset classes. And we had my colleagues down in Brazil were kind of talking and using stablecoins long before I heard anyone in the U.S. The first time I used a stablecoin was a couple of years ago because I was like, well, I should probably use one of these things since I'm talking about them all the time. And it was kind of, but I didn't really have a need to, right? Because I have access to the dollar, I have access to these banking services. But for the people, hundreds of millions of people outside the U.S. that don't have access to it, it's a huge, huge thing, and that demand I think is only going to increase.
And when we talk about like people who are blockchain enthusiasts, as clearly we all are, but people talk about it's a cheaper, better, faster way of doing something, and stablecoins are essentially tokenized cash. There's a little more to it than that, but that's what they are. And sending a stablecoin can take, right? It usually takes less than, depending on what network you're on, it takes less than 4 seconds to settle in finality, regardless of where the dollar originates and where it ends up. And so the average stablecoin transfer fee on Solana, for example, is $0.000001. And if you think about the last time that you went to your bank and sent an international wire transfer and it took 5 days and you paid more than a cent or a fraction of a cent, that's what we're talking about, is that it is does absolutely change the game. And we've seen a lot of incumbent sort of firms that use really significant cross-border payments, like Western Union has announced that they are now going to use stablecoins on their back end, and they're going to use those stablecoins and they're going to run them on Solana, right? And so there is, we've seen more than 9 trillion of volume over the past 60 days on stablecoins on chain. And we haven't even gotten the final rule implementation following Genius. So I think when we sort of think about what that means over a multi-year period, we're going to see substantial growth.
This has gone super quickly, and we do want to leave a little time for questions. I would love each of you to talk about where you think the sort of short and long-term future is for digital assets. I'll start with Alex.
Sure. I think, innovation is obviously the buzzword. Strive was super proud 2 weeks ago. We became the first security in history through our pref to pay daily dividends. And I think that this is a natural evolution for tokenization, right? The ability to program payments daily, hourly. We're doing it TradFi way daily. And I think that that's going to be a really interesting use case for both stablecoins, tokens, and maybe even prefs as we look at expanding the way we think about money markets, cash. The utility of a daily dividend is radically different than monthly dividends, which is what we're accustomed to, semi-monthly. The benefits, of course, are higher yield because of daily compounding, lower volatility, which allows the use case to transition from a financial instrument in your income portfolio to something more akin. So that's what we're most excited for at Strive, is seeing how distribution frequency changes the way we interact with money.
I think the investment landscape for crypto assets becomes more robust, and we see an increasing number of sophisticated institutions beginning to participate, and we see the sort of market continue to mature. I also think that in 3 years to 5 years, that 80% of you will have a tokenized asset of some sort in your virtual wallet, and I think that you may not even know that that's the case. It may be in your bank. It may be on your Schwab account. You may not know, but I think 80% of the people in this room will own a tokenized asset in between 3 and 5 years.
Yeah, so I think short term, really all eyes on the legislative front. And someone mentioned it just, if clarity doesn't pass, maybe it just slows down the adoption cycle, but it's inevitable over the long term, in my opinion. And if we take a step back and think about one of the largest, if not the largest trend right now in markets is AI, and it's, what the implementation is going to look like, how is that going to change things? And, thinking about, how an AI agent could more seamlessly interact with digital money or digital assets. Like an AI agent is not going to walk down the street to a bank. They're going to have some sort of digital money to be able to do whatever task it is that they're going to do. So when you think about how that's going to integrate into a lot of things in in the ecosystem, it basically kind of come back with the conclusion that it's inevitable that pretty much everything's going to be tokenized at some point. And that's my view.
We might have set a record for the longest panel without mentioning AI until, 48 minutes in? So, but to just piggyback off that one point, I think the intersection of AI and crypto is real, and I would say, our lives are, whether we like it or not, becoming increasingly digitalized, and so, as you think about kind of stable coins, as you think about tokenization, as you think about the intersection of AI and crypto, these digital assets are going to be at the heart of all of that. And again, kind of reiterating what Mike said, regardless of what happens with the Clarity Act, this train has been set in motion and it's not stopping. And whether that means, if the Clarity Act doesn't pass, things get pushed offshore, they're going to go somewhere. And so I would just say, prepare yourself for this future and be curious about all the work that's going on in the space.
Great. Jack, are there any microphones out for questions? Okay. Right there.
So I'm very appreciative of the more, I would say, grounded regard that the panel has for these, new asset classes. What do you guys kind of see coming down the pike as far as, is this a replacement for, the U.S. dollar as we know it, or is it mainly kind of an alternative investment currently until things kind of maybe progress towards where we can regard a less tangible currency, because I think our society is so adapted to things that they can touch and feel, and crypto is more of a digital product that people can't conceptualize. What is this looking forward as far as just the state of transactions in the U.S.?
Yeah, I can take a stab at that. It actually, one of our themes for 2026 was the rise of the quote-unquote crypto dollar. And by that, we essentially mean two things. One, stable coins, and we're anticipating that stable coins are going to continue. It's about a $320 billion market cap now. We're anticipating that to grow maybe as much as 500 or more by the end of the year, which is going to create new demand for the dollar, for treasuries, right? So it's actually, a lot of people were saying that the Genius Act was more of a bill focused on the US dollar than crypto because of that impact. At the same time, you do have the Bitcoin's thesis playing out to a certain extent. Like more recently, if you look at what happened with the Strait of Hormuz, with Iran accepting Bitcoin as a toll through the strait, I think that's a clear sign, in addition to some of the de-dollarization trends that we've seen already, that Bitcoin is playing something of a role, like a macro role, as a non-sovereign, borderless asset. And so how long it takes for that to actually play out and disrupt the dollar, I mean, we don't think the dollar is going to lose its reserve currency anytime soon. And as I mentioned, stablecoins are only going to, I think, continue to strengthen it. But I do think it's going to be interesting to kind of watch how the Bitcoin thesis plays out over the coming years.
Yeah, as the firm that's a Bitcoin maxi, I'll take that side of the trade. The dollar debasement trade is playing out in real time. That's just one anecdote. M2 supply continues to inflate, and that's your debasement trade. And then you look at the global debt crisis, right? DC and every government in the world refuses to stop spending. Our co-founder of Strive actually helped initiate Doge with Elon and President Trump, and it was an unpalatable solution in Washington D.C., irrespective of party, to not spend ourselves into oblivion. So we're singularly focused on Bitcoin. That is one of the main drivers. We're not going to handicap a time frame, but it's definitively playing out as we anticipated.
One more? How about,
I do have a question.
Sure.
And my question is very simple. Why are we not investing in this asset class? I am a dinosaur. I have no idea why are we investing in this asset class. For example, just 2 days ago, Bitcoin just plummeted from $77,000 to $68,000. I could not understand why. Is that basic fundamental question? Somebody answer that for me.
Sure. So, do you know what the single best returning asset across multiple time frames is over the last 15 years? Do you know how many time series on a rolling 4-year CAGR? There's about 4,500 time series. Less than 0.5% of those rolling 4-year CAGRs are negative. There's never been one on a rolling 5-year. There are multiple massive volatile periods in a 1 year. This is innovation. This is the future. You can't have a society that debases currencies, that overspends, and not have an asset step up with pure governance, complete transparency, zero immutability. The characteristics of Bitcoin specifically are superior to every single asset on the planet, and the time series is showing that. But I don't think you're going to become an investor either way, and that's okay, right? It is. It's not a criticism. But the data supports why we do this. The governance characteristics are supportive of that time series history, and that's why we all do what we do.
I have a question. So Alex, specifically about the SADA.
Oh, yes.
Yeah,
Sorry,
specifically about your preferred SADA, like, basically, it's considered the yield is considered return of capital for a number of years, so you don't pay tax. Could you explain that, how that works?
Sure. Well, I have to say that I'm not there's not tax advice. Maybe Mike should do it. The return, the distributions to date have been funded by capital markets activities. So the IRS, or actually I should ask my lawyer over here. The IRS treats it as a return of capital. So you're stepping down every 13 cents or 12 cent distribution, you're stepping your cost basis down, and then at the end, if you were to sell this, then you would face a capital gain off of a cost basis after whatever the math is, 13 months of, basically zero. Michael Saylor created these prefs. He was like nerding out on AI, so I guess it's the second time we mentioned AI. That actually just happened. It wasn't created to be a return of capital vehicle. That is an added benefit. But, we ran a table. Is this marketing, Seda? I don't really know. That after-tax distribution is tremendous when you're looking at a notional 13% distribution, and you think of the high-tax states like New York, California.
That's what I'm asking. I'm just confused.
Yeah.
How about one more? One more right there? There we go.
So I run an RIA and I custody with Schwab. I'd say more than about 50% of my clients are all baby boomers. And I would love to make them some money and differentiate myself as an advisor by offering them digital assets and or stable coins. What are your suggestions of how I get them started with something that is publicly traded and I could buy through Schwab and make them some money?
So, I won't pitch our own ETF at this point, but I will pitch the idea of getting a broad-based exposure to this asset class. So the NASDAQ CME Crypto Index is what our ETF tracks. I think, a couple things. One, there is the generational divide was mentioned earlier, and that is absolutely real. Like trying to convince my 76-year-old mother that I'm not working in some scam industry is like very difficult. But I talked to my 19-year-old niece, and she's like, "Oh yeah, digital currency makes perfect sense." And we see that with advisors and investors all the time, right? There's just more of a embrace from the younger generations of this technology. But I would say like a small allocation, right? The crypto asset class makes up about 1% of total global investable asset classes. So if you're talking to one of your clients, and they don't have at least 1%, it's an active bet, right, against that portion of the overall global assets. So I think, starting slow, right, rebalancing all the things that obviously how to do as an RIA, I think applies to this asset class as it does every other asset class. And so I think it's kind of maybe the baby steps approach is probably the best way.
I'd like to thank our incredible panel. So knowledgeable and passionate, which is great. And thank you all for listening to us.